5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to the Follow the Money podcast. My name is Jerry Robinson, your host. It's great to have you along today. We've got a big story that is pretty much impossible to ignore. That's physical gold prices breaking through what we would call a historic milestone here. Just days ago, we saw gold surge above the psychologically crucial $3,000 per ounce level for the first time in history. And as I record this broadcast on Wednesday, the 19th of March, in fact, we're recording this just before the Federal Reserve is set to announce its latest rate policy. We expect the Fed to leave rates as is. We don't expect them to make any changes. However, they will be releasing their latest outlook and what they call the dot plot, which kind of tells us what Federal Reserve officials are expecting for future rates, as well as their outlook on future GDP growth rates and things along those lines. So we'll be providing a big update to our members tonight by email on what we see from that. But the focus of this podcast, especially the first part, we're going to focus segment one on the latest breakout in gold above that $3,000 level. As I record this today, we've actually hit a high of $30.52, so $3,052. That was reached a little bit earlier today. It's trading off of those highs. Now, for longtime listeners of the Follow the Money podcast, we've been tracking gold's movements closely for years. We track it for our members here at followthemoney.com. We talk about it regularly on this broadcast. It is one of many different assets that we like to track. We own physical gold for the long term. We've been holding gold for many, many years. And we do think that there could be more potential upside ahead. That's what we're going to talk about today, because we've been watching this price rise for some time, and we want to provide you some of our latest insights. Now, we've seen the ups, we've seen the downs, we've seen the skepticism around the yellow metal and even the euphoria. But this latest breakout really is getting the world's attention, because it's really not happening in isolation. There's a convergence of other powerful economic forces at work here that are really fueling this impressive rally. And that's what we're going to talk about in segment one. So let's take a deeper dive into what's pushing gold prices to record highs, and let's explore how high they might climb from here. Let's dive in. It's no secret that gold typically benefits when uncertainty is on the rise, and investors really crave safety and stability during turbulent times like the ones we're in now. And gold has consistently offered a refuge from the storm, so to speak. And right now we're facing a backdrop of escalating geopolitical tensions. We've got ongoing conflicts in Gaza. We saw that the ceasefire just came to an end, very unfortunately. More deaths now occurring in that region. In Ukraine, of course, that conflict's still ongoing, but there's hopes that we might see an end to it. We know that the Trump administration recently bombed Yemen, but it's not just geopolitical instability that's kind of rocking the boat right now. We also have economic uncertainty as well. You have the Trump administration's tariff strategy, which is pretty much reshaping global trade. I mean, it's threatening to. It's injecting volatility into the financial markets, creating an atmosphere of unpredictability, and the markets hate uncertainty. Investors and businesses and even central banks around the world are unsure of what's going to happen later today, let alone tomorrow, right, in this current environment. So it's understandable that gold is becoming more attractive, not just as a speculative bet, but as a real, genuine safe haven asset. Now, if you've been following gold for any time, you know that central banks have been quietly signaling their concerns about the overall economy by dramatically increasing their gold reserves. In fact, in 2024 alone, the latest data that I have shows that global central banks bought over 1,000 metric tons of gold. That's an astonishing figure when you think about something that John Maynard Keynes called the barbarous relic. It's really quite stunning, isn't it? It really shows you that these financial institutions tend to speak out of both sides of their mouth. They say, well, nobody should own gold. And then meanwhile, they stockpile it themselves, right? So this is marked, in 2024, we marked the third consecutive year of strong central bank buying of gold. And that trend is continuing very robustly into 2025. Now, you might ask, what's driving this rush to gold by the world's central banks? Well, it's pretty clear. You have countries like Uzbekistan, China, Kazakhstan, Poland, and India are consciously diversifying their holdings away from the U.S. dollar. And the reason is because they've seen the dollar weaponized through sanctions and political tensions, especially since the freezing of Russia's central bank reserves after the Ukraine invasion. That scenario is shaking trust in these traditional reserve currencies, the U.S. dollar chief among them, and it's causing central banks to hedge their bets and boost their gold holdings in times of uncertainty. So we have this de-dollarization trend, which I wrote about that in my book, Bankruptcy of Our Nation, over a decade ago. I mean, this trend is still here, and it's accelerating, much more so than when I wrote my book many years ago. And it doesn't appear to be ending anytime soon. So too, in not just central bank buying of gold, we've also seen regular, Joe Blow investors, regular retail investors, and institutions alike have been piling into gold ETFs at a pretty stunning pace. You may know for the last few years, gold ETFs had suffered outflows, pretty significant outflows, but that's all changing as we speak. Physically backed gold ETFs recorded inflows of a staggering $9.4 billion in February alone. That's last month. That was the strongest monthly inflow we'd seen since March of 2022, just as we were moving into a very concerning inflationary period where the stock market came down and gold became more attractive. So to put this into perspective, if we look at the largest U.S. gold ETF, that's the iShares BlackRock Gold ETF, GLD, it saw its assets jump from around $73 billion at the end of 2024 to nearly $87 billion in just 2 months. So when we see that kind of rapid influx into gold funds, then it's a clear indication that institutional investors, retail investors alike, are anticipating, whether they're right or wrong, they're anticipating further turmoil and uncertainty, and they're just positioning themselves accordingly. And then, of course, we have the tariff tensions, particularly Trump's reciprocal tariffs that are igniting fresh fears of inflation and economic disruption and supply chain issues and all of these things. Tariffs essentially function as taxes, right? They increase the cost of imports and they directly impact prices that consumers pay for everyday goods. Now, based upon what I've seen, I've kind of gone through some of the tariff implications. I'm not convinced that we're going to see a tremendous amount of inflation from what I've currently seen. And I'm not so convinced, quite frankly, that the Trump administration is going to maintain these tariffs all the way. They may just simply be a bargaining chip that will be used to be taken off the table later, which could spark, by the way, a big rally, which has caused me to be somewhat suspicious of those who are going too heavily short in this environment of U.S. equities, because I think we've seen already a very natural correction in the markets. We're going to get a bit more into what's happening in the broader financial markets in segment 2. But, right now, as uncertainty around these tariffs grows and you have volatility elevated and equity markets are, kind of shaken, once again, investors are looking to gold as a reliable hedge against both inflation and market turbulence. So the idea that gold has lost its luster is being proven wrong yet once again in 2025. So as long as we're stuck in this cycle of tariffs and retaliatory actions from Washington, and of course, all the uncertainty that surrounds it, then we expect that gold is likely to continue to shine in that kind of environment. Now, if you look at analysts and major financial institutions, they're continuing to raise their forecasts and price targets for how high they expect gold to go, particularly this year. If you look at Goldman Sachs, for example, they just recently forecasted that gold will hit $3,100 per ounce by the end of 2025. I mean, we're practically there. We're just $50 away as of today. UBS has even higher expectations, setting their target at around $3,200. That actually concurs with my own forecast that I released at the beginning of the year. We expected gold to hit around $3,200, sometime this year. And again, we're getting very close to that. Now, other institutional outfits like Macquarie Group or even Bank of America, they're setting price targets of around $3,500 an ounce this year. And that's a pretty big significant upside, I should say, from current levels. But it's also kind of a boost in their former forecasts. So it's pretty clear that institutional investors are seeing the writing on the wall, so to speak. And then you also have the prominent investor, Jeffrey Gundlach, over at Double Line Capital. He's probably got the most aggressive gold forecast that I've seen on Wall Street. He's saying that gold would likely hit as high as $4,000 per ounce within the coming years. He didn't put a date on it. He just said over the next few years. I think that's pretty feasible. So clearly sentiment among these institutional investors is extremely bullish. And quite frankly, that makes me a little nervous because we've had such a big rally, and oftentimes institutional investors will kind of join the party late after everything has kind of happened. So yeah, I certainly think that we could continue. And I think that if the current uncertainty and the tariffs and all of this stuff just continues to linger, and if we continue to see chaos in the form of war in various theaters around the world, then yeah, I think that gold could still power higher from here, even though it's technically overbought on the monthly chart. If you look at a monthly chart of gold, you'll see that it is technically overbought using a few different criteria. But although gold has just breached $3,000 for the first time, I mean, $3,000 an ounce. Think about that for a minute. I mean, it was just a few years ago we were talking about gold at say $1,600, or even many years ago when it was well below $1,000. So everyone who has ever bought gold bullion as of this month, as of this date, is in the black. Every single person, if you bought it, say, a year ago, or you bought it 2 years ago, or 4 years ago, or whenever, 6 months ago, you're sitting in the black as we sit at this fresh high. But it's critical to realize that this price level is not really an all-time high if we factor in inflation. In fact, gold hit its true inflation-adjusted peak back in 1980. And if you use U.S. dollars adjusted for inflation, that price would have been around $3,800 per ounce. So that means that in real purchasing power terms, today's price of $3,040 or whatever it is currently is still well below that historical high watermark. And to me, that suggests that the current rally could have more room to run, just based upon that fact alone. So, despite the headlines telling us record high prices, gold still appears somewhat undervalued when viewed through the lens of history. And one little thing I want to add about this whole topic that I haven't really seen a lot in the press, but it's very important. There's been a major regulatory shift in China. It's a pretty big deal that could propel gold even higher. And that is that China has begun allowing its large insurance companies to allocate up to 1% of their assets into gold investments for the first time ever. Now, that may not sound like much at first glance, but that 1% allocation translates into potentially $27 billion of fresh new demand for gold. $27 billion entering an already tight market. That could be powerful enough to help sustain the upward movement, for gold's current momentum. And then really quickly, just giving a quick word about gold mining stocks. We've been seeing them rise, across the board, especially in our ETF leaderboard where we track the major gold mining ETFs. Gold miners have experienced a pretty dramatic increase in profitability because of the surging gold prices. Think about it. Many of these companies now are selling gold that they mine out of the ground at the highest level they've ever had. So profits should be going up, right? You would expect it at least. Take the popular gold mining ETF, GDX. That's the Van Eck Vectors gold mining ETF. You take that, it's up almost 33% year to date. And you compare that to the S&P 500, which, year to date is only, up around, well, it's actually down. It's down about 3.5%, so that's pretty crazy when you think about what's going on in the gold mining space. And they've really underperformed for some time. So now they're playing some catch up. And even if we don't see gold go higher from here, we still believe that gold miners could still do well with $3,000 gold, even if it just hangs out here. That's some really good potential profits for these companies. And what's fascinating, at least potentially profitable for savvy investors, is that despite these strong gains that we've been seeing in gold miners, many of them are still historically undervalued. I mean, they're generating record revenues. They should be generating record profits. Some of them aren't, sadly, but some of them are. And yet their stock prices really haven't fully adjusted upward. And so in other words, gold miners continue, I think, to offer attractive investment opportunities, allowing investors to effectively leverage their exposure to rising gold prices. I think, perhaps a lot of the upside has already been baked in, but I think there's probably some more room to the upside. So if we just take a step back here and take a look at the big picture, it's clear that gold is benefiting from a rare combination of a few factors that are coming together. You got geopolitical uncertainty, you got aggressive central bank buying, you've got these explosive ETF inflows that we're seeing this year, you got tariff-fueled inflation worries, you got bullish institutional forecasts, you got historic undervaluation relative to inflation-adjusted highs, you got fresh new demand from China's insurance companies, and the undervalued mining stocks. It all kind of points to a continued bullish outlook for gold. And so while all that's bullish, I still want to remind you that nothing goes straight up, and nothing goes up in a straight line. Gold will encounter headwinds and volatility along the way. And by the way, I said it's already historically overbought when you look at technicals, right? So gold, I think, will encounter some headwinds. It's going to encounter some volatility. But given the current economic climate, I think we're witnessing a rally that could have a bit more room ahead. I still think we'll hit $3,200 this year. I think gold miners could play catch up in that environment. And as we've talked about many times here on Follow the Money, it's important that you stay diversified, keep that positioning very prudent, especially in times like these. Absolutely key. So just a little guidance there on gold. We think $3,200 is where we probably are going to hit this year. I think gold miners still have a little bit more upside this year as well. We are technically overbought, so we would expect some selling pressure to eventually arrive. So there's our latest take on the gold rally. We're out of time for this segment, but don't go anywhere. After the break, we're going to dive into our latest market commentary on the broader financial markets here in the U.S. We're going to talk about the S&P 500, the dollar. We'll look at some international markets and Bitcoin. Stay tuned. There's a lot more to cover. Hey there, traders. Jerry Robinson here. Before we jump into our market update, let me take a quick moment to introduce you to our brand new video course, Swing Trading Simplified, Charting Your Way to Profits. This is a new program that I have poured my heart into at the beginning of this year, and we're focusing on the exact steps that I have used over the years to achieve consistent swing trading results. Now, this is a 10-module course, and this is the most comprehensive course we have ever released on swing trading. Now, in this course, you're going to learn how to identify market trends and time your entries with precision. You're going to learn from me the essential indicators that you actually need to succeed without all the noise. You're going to find ways to pick the right stocks, ETFs, all based upon liquidity, volatility, and sector performance. The course is going to empower you with a rules-based system for managing risks so you'll know when to cut losses and when to let the winners run. And you're also going to learn the psychology of swing trading that'll ensure that you stay disciplined even when your emotions are tempted to run high. And here's the best part. As a followthemoney.com member, you're going to gain access to each of these videos in the course as we release them. We've already released the first 3 modules, and we're releasing a new one every single week for the next several weeks. It's like having a personal guide through every phase of swing trading, whether you're a complete beginner or whether you've been trading for years. So if you're ready to take a more structured approach to the markets, head over to followthemoney.com/join, become a member today, and get instant access to our ongoing Swing Trading Simplified course. We can't wait to welcome you aboard and help you level up your trading skills. I'll see you on the other side.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Welcome back, friends. You're listening to one of the longest running personal finance podcasts in the world. Followthemoney.com is where you find us online. I hope you enjoyed that update on gold. We wanted to provide you with just a good overview. We've been talking about gold for so long. We decided, hey, we got to do something. It's at 3,000 now. It's kind of a big milestone. Is it going to 4,000? We'll see, huh? We'll see. I think we'll certainly see some weakness before that happens, but nonetheless, what a rally we have seen in gold. Now, in this next segment, what I want to do is I want to provide you with some of our latest market commentary. The markets have been pretty wild lately. There's a lot of fear, a lot of volatility in the markets. Quite frankly, it's not that big of a deal unless you're talking about certain specific stocks. If you look at the general or the broader, financial markets like the S&P 500, which we'll do in a minute, you'll see that we're experiencing what is really a garden variety correction. The markets just entered a correction, which is defined by a 10% pullback from a recent high. And so, that is not really something that we should be too alarmed by. I mean, that is, in fact, what markets do. They don't climb up forever and ever and ever. And we've just been really enjoying for the last couple of years, we've really enjoyed a fairly smooth ride up in terms of the S&P, the NASDAQ 100, the Dow Jones. We did have some pretty big volatility last August, but overall, we really haven't seen a pullback to the 200-day moving average on the S&P for some time. So this is absolutely normal. Let me just explain that first of all. Now, maybe the problems we're experiencing don't feel normal, and maybe they're not in some ways. Maybe they're a bit abnormal for our 21st century. However, the market's pulling back the way they have is not unusual at all. So no need to be concerned about that, in my opinion. Now let's talk about the S&P. We'll start with the S&P 500. It's obviously the biggest market. It's been struggling a bit so far this year. It's down about 4% year to date. Market sentiment continues to be pretty cautious. Consumer sentiment, consumer confidence, those numbers are not looking good right now. Certainly there's a lot of concern and fear driven by the ongoing volatility triggered by escalating tariffs from the Trump administration, and also the geopolitical uncertainty we're seeing around parts of the world. So, investors are pretty wary about the potential for these tariffs to fuel further inflation. The charts indicate a lack of clear direction right now. We remain in an uptrend, but right now the markets are just consolidating. For example, the S&P consolidating just below a rising 200-day moving average. And note, the 200-day moving average is still increasing. So that tells you something. That indicates that we're still largely in an uptrend, despite the pullback. The area I've been watching, the technical level I've been watching on the S&P 500 proper here is 5650. Which has been serving as some resistance. We're trying to overcome that area today. That's an area I'll be watching in the wake of the Fed announcement later today to see how we close. If we close above 5650, that may suggest that we're going to try to make a run for it and move back up to that 200-day moving average, which is currently around 5750. If we get up there and we break through the 200-day, that's going to be quite something. That will indicate that we may be in for maybe a V-shaped recovery from this. We'll have to see. No one has a crystal ball. But as I mentioned, the traders are pretty cautious right here. They're waiting for clearer signals. So we're going to continue to watch this market as it plays out. But the S&P 500, 5650, the key level I'm watching. We seem to be also sitting right at the 50 weekly moving average, which is also a very important moving average for longer term oriented folks to pay attention to. So the S&P certainly something we're keeping our eye on. Another market that we like to follow, which tells us a whole lot about the current state of the market, is the U.S. dollar. It additionally is down about 4%, and it has really come down sharply. Just back in, late February, we were sitting at about 107 on the U.S. dollar index. It has since fallen down to where it's at now, about 103, 104 in that range. That's a huge drop for a currency. Currencies don't tend to move that quickly. This was a very sharp drop, one of the sharpest drops we've seen in some time. And that actually fits what we've been expecting. The dollar is getting hit by all kinds of things. There's obviously the global economic anxiety that's undermining confidence in the U.S. dollar. Now, it's interesting that we're not seeing a big rush into the dollar. We're seeing a big rush into gold and what else? International stocks, which I want to talk about next. We're seeing major strength starting with Europe. 2025 has brought some outstanding returns across the continent of Europe, which is reflected prominently in our ETF leaderboard. We keep track of all manner of ETFs in our ETF leaderboard, and we track them by trend ranking. We track them according to momentum ranking. And right now, Austria, the iShares Austria ETF, EWO, is holding at the number one spot in our ETF leaderboard. And that's out of the 150 ETFs that we track in that leaderboard. We've also been seeing some pretty big improvements from the Global X Greece ETF, GREK, and the iShares Poland ETF, EPOL. Both of those moved up 4 spots in our ETF leaderboard last week. Poland, by the way, EPOL, the Poland ETF, is actually the best performing market year to date in our ETF leaderboard, up 37.6%. It's followed by GDX and GDXJ. Both of those are up more than 30%, followed by KWEB, which is the Crane Shares China Internet ETF, up about 29%. So again, if you look at the top 10, top 20 ETFs based upon year-to-date gains, we're talking about Europe, we're talking about Asia, and we're talking about gold and silver, right? I mean, that's pretty much what's happening right now. We're seeing, which, by the way, explains why I am not as much, perhaps as concerned as some others are about the current state of the U.S. market, because it's showing me that investors are still investing. They're just not investing in the U.S. right now, right? They're investing in gold. They're investing in silver. They're investing in Europe. They're investing in China. These areas are seeing some pretty big inflows. They're investing in emerging markets, but they are not investing so much in the U.S. market. And I think that's pretty reasonable as to what's going on here in the U.S. There's a lot of uncertainty. So to me, if we were preparing to enter some sort of major economic recession here in the United States, they often say that, the United States, sneezes and the world catches a cold. You'll typically see that in other markets. Other markets will begin to come down in anticipation of the U.S. coming into a very weak spot because our consumer drives so much of global economics. But that's not what we're seeing. We're not seeing people run for the hills in terms of investments. They're just diverting from the U.S. to Europe or to China, right? And so overall, international diversification is paying off big time in 2025. It hasn't, by the way, over the last few years. It's been a tough market for the international markets, really. The U.S. has been dominant. But this year, that's changing. And don't forget, in Trump's first term, going back to 2017 through 2020, China did fantastic in terms of its equity market. So We had mentioned at the beginning of the year in our market outlook for our members, we said we expect China to be an outperformer. We expect gold and silver to be an outperformer. And we're certainly seeing that this year. So we're definitely seeing big flows into Europe and into China. Now, let's briefly talk about silver as well. We didn't talk about silver when we were talking about gold earlier today. Silver is actually up around 19% year to date. And, physical silver ETFs like SIVR, which we track in our ETF leaderboard, are really gaining traction because of surging industrial demand and a rush to safe haven assets in the face of this tariff-related inflation worry. Supplies remain really tight for silver. Also, they've been impacted by increased silver lease rates. That's the cost to borrow silver, and persistent supply chain disruptions. So you have this combination of strong physical demand for silver. You have limited supply. Makes it a pretty appealing play for traders looking for momentum in the commodity space. We have an expectation of seeing silver probably hit $40, very likely this year. That's pretty much our target for 2025 for silver. I don't think that's out of the realm of possibility. And that still wouldn't be a fresh high for silver. Silver is still trading well below its 2011 highs. Now, finally, let's talk about Bitcoin, because Bitcoin has also been pretty hammered in this current environment because the risk-off mentality in the markets. Despite the fact that the United States has warmed up to Bitcoin, despite the fact that it's talking about a strategic Bitcoin reserve, despite the fact that we've seen numerous lawsuits by the SEC dropped on the crypto industry, they've just been simply washed away in this new administration. So the crypto space is obviously experiencing much more favorable policies and favorable treatment from Washington. And yet Bitcoin is still struggling right now. Bitcoin right now, as we speak, is down about 9 or 10% year to date. For 2025, it's trading right about 84,500 as I record this. And Ethereum, of course, has been really hit hard. If you look at Ethereum, you'll see that the price of Ethereum is down about 38, 39% year to date. It's back up above 2,000 as I record this, but it's been hit pretty hard this year. So, despite the fact that gold and silver have attracted investors worried about inflation, cryptos are struggling to maintain positive momentum amid the regulatory uncertainty. I've often said that, if you want to look for a direct relationship in terms of equities for Bitcoin, just look at the NASDAQ 100. That's my niche. That's my specialty. And I've noticed that there's a pretty strong correlation between the trend of the NASDAQ 100 and the trend of the of Bitcoin in particular. And so right now we're just seeing those market jitters across the board. And so Bitcoin's weakness really kind of shows that the market is just looking for some stability amid the market turbulence. Now, Bitcoin is holding up well. I mean, don't get me wrong. This is, 84,000 is nothing to sneeze at, but it's certainly off of its highs. And we've certainly lost a lot of the post-election gains that we had seen after Trump won his second term. So overall, we look across the markets, we see, European and Chinese stocks are the clear winners in 2025. U.S. equities and Bitcoin and other cryptocurrencies are under pressure here. You have commodities like gold and silver continuing to shine. They're really benefiting from those inflation fears and the currency weakness here in the United States. My suggestion to you out there listening is to stay disciplined, to not allow the current volatility to alter your long-term strategy. As we've often said, you want to manage your risk wisely, of course, but you also want to stick with your long-term investment plan. In fact, these are the moments where you have the opportunity to pick up higher quality assets at a discount. This is kind of odd because the financial markets are one of those only places where when things go on sale, people run out of the store with their hair on fire and they don't want to buy anything until things go back up. Every other store on the planet, when things go on sale, people are like, yes, they want to go buy. So it's kind of a strange psychological phenomenon that occurs in the U.S. stock market and other markets as well. Investors get a little scared, but the ones who hold their nose and go ahead and buy at lower prices, if they have a long-term time horizon and if they're choosing high-quality assets, over time, things tend to work out pretty well. So that's our advice as we look at the broader markets. And there's a quick wrap of our market commentary. We'll be right back with our final segment. Hold tight. Well, friends, as we wrap up today's broadcast, let's take a moment to step back from all the noise. The headlines are loud. The news media is constantly telling us reasons why we should be afraid or reasons that we should be concerned. And of course, the markets are volatile and the uncertainty seems to be everywhere we look. It's precisely in times like these that it's essential to maintain that steady, long-term investment perspective, right? You know that investing successfully is not about reacting to every single news cycle, to every single news headline, and trying to constantly be ahead of it. That's traders now. That's different. Of course, they're trying to chase every new trend, but the investor doesn't do that. It's about clarity for the long-term investor, composure, discipline, right? Qualities that are often tested, but deeply rewarding, especially when the markets feel chaotic. And that brings me to a powerful piece of wisdom from Seneca, the great Stoic philosopher from ancient Roman times. I've been reading through his book on ethics over the last few months. It's been really enjoyable. And I just pulled this quote out of one of his letters to Lucilius when he wrote, "We suffer more often in imagination than in reality." Now, that's some timeless wisdom, isn't it? That reminds us that much of our anxieties, much of our fears, our uncertainties, they aren't actually grounded in reality often. Instead, we're often simply reacting to the imagined scenarios that we construct in our minds, often much worse than what reality brings. How often do we worry about something and it doesn't actually come to pass? It's true. We suffer more often in our imagination than we do in reality. And we can apply this to investing, right? Fearful headlines, short-term market swings, these can all lead us to panic or to make hasty decisions that we might regret later, usually at the exact wrong time, by the way. The reality, more often than not, is far less dramatic. So today I encourage you to take this piece of wisdom and let it guide your investment journey. Remain calm amidst the volatility, right? Be informed rather than fearful. And try to make your decisions in a place of clarity and calm. That's how successful investors consistently navigate uncertainty, not with fear, not with breathless anxiety, but they do it with thoughtful calm and measured confidence. Maybe easier said than done, but true nonetheless. And that's just something to think about. As always, friends, thank you for allowing me into your life right here through this broadcast each and every time we do it. And until next time, remember, when it comes to your money and your life, always follow the money. God bless, and I'll see you right back here next time.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussion on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.